Hi there, and welcome to the Property Wealth Podcast. We're so glad you're joining us today.
Absolutely. It's great to be here, Sarah.
So today we're diving into a really interesting topic that can actually change the way you think about financing your property investments.
Right. We're talking about life insurance premium financing for property buys. It might sound a bit unconventional, but it can be a game changer for the right investor.
Yeah, it's all about using your resources wisely, right? We'll explore how this strategy can help you leverage your assets and potentially maximize returns.
Exactly. We'll also discuss some practical tips on how to get started, the benefits, and maybe even some pitfalls to watch out for.
And don't forget, we'll share some real-life examples of investors who've successfully used this strategy, which can really help put things into perspective.
Plus, we'll touch on the importance of working with the right advisors and understanding the ins and outs of insurance products.
So whether you're just starting out or you're looking to refine your approach, there's something here for everyone.
Let's jump right in, shall we?
Yes, let's get started.
So, when we talk about life insurance premium financing, it really hits home for a lot of folks, especially if you're over 40.
Yeah, I can see that. It's like a bridge between securing your future and investing in property, right?
Exactly. At this stage in life, many people are really starting to think about their retirement timelines. You worked hard, saved, and now it's about making those savings work for you. The earlier you start thinking about these strategies, the better.
Right, and with inflation being what it is these days, you want to make sure your investments are keeping pace or ideally outpacing inflation.
Definitely. I had a client, let's call him Tom, who was in his early 50s. He had a solid portfolio but was worried about how inflation would eat into his savings over time. He started using life insurance premium financing to leverage his policy and invest in real estate.
That's a smart move. So he essentially used the policy as a tool to access funds for investment without liquidating his assets?
Exactly. He took out a loan against the cash value of his policy, which allowed him to buy a rental property. And the beauty of it is, as the property appreciates, he's building wealth while also keeping his life insurance intact.
That sounds like a win-win. You get the security of the policy and the potential growth from the property.
Right, and when you think about market shifts, we've all seen how unpredictable things can get. Having that kind of financial buffer is crucial. Tom was able to secure a property that turned out to be a real gem, and he's now got a steady income stream coming in.
And that income stream, plus the appreciation of the property, it's like a safety net, isn't it?
Absolutely. Plus, for many people, there's that emotional side of financial security. Knowing that your investments are working for you and that you have a plan in place can really ease a lot of worries.
Yeah, it's not just about numbers. It's about peace of mind. And especially for those with kids or family, this strategy can also play into wealth transfer.
Right. Tom, for instance, was particularly interested in leaving a legacy for his children. By investing in real estate through his life insurance, he not only built wealth, but also created an asset that they could inherit.
That's huge. It's like setting them up for success, too. You're not just thinking about your retirement. You're thinking about their future as well.
Exactly. And in today's economic climate, where markets can fluctuate wildly, having diversified income sources is more important than ever. Real estate can provide that stability. A tangible asset that often appreciates over time.
And let's not forget about the tax advantages, right?
Oh, for sure. Depending on where you live, there can be significant tax benefits associated with real estate investments. With life insurance premium financing, the interest on the loan could potentially be tax deductible, which adds another layer of appeal.
That's a great point. It's like finding ways to make your money work harder for you, which I think a lot of people want to do, especially as they approach retirement.
Exactly. And with current economic trends, more and more people are recognizing the importance of having a solid financial plan. The earlier you start, the more options you have down the line.
So true. It's like that old saying, don't wait until you're parched to dig a well, right?
I love that analogy, and it's so relevant here. The proactive approach really can make all the difference.
And I think it's also about feeling empowered to make these decisions. Learning about strategies like this can really change how you view your financial future.
Yes, it's about taking control. A lot of people feel overwhelmed by all the information out there, but it really can be simplified.
Right, and hearing stories like Tom's makes it more relatable. It's not just theory, it's real-life application.
Exactly. And another investor I worked with, let's call her Lisa, had a very different approach. She was more risk averse, but still wanted to utilize her life insurance policy. Instead of directly investing in a new property, she used her policy to create a line of credit that she could tap into if needed.
That's interesting. So it's like a safety net for her investments, just in case the market took a downturn?
Exactly. Lisa felt more comfortable having that flexibility. If she saw a great deal on a property, she could jump on it without jeopardizing her existing assets.
That's smart. It's all about finding what aligns with your own comfort level and financial goals.
For sure. And that's why it's so important to have these conversations. Everyone's situation is unique, and understanding the options available can lead to better, more informed decisions.
So whether you're like Tom, diving into real estate headfirst, or like Lisa, taking a more cautious approach, there's a strategy that can work for you.
Exactly. And now that we've laid out why this matters, we can dive into some core strategies. So Sarah, when we talk about life insurance premium financing for property purchases, it's really important to understand how to evaluate a deal effectively. One of the first things I always look at is the 1% rule.
Right, the 1% rule. That's where the monthly rent should ideally be about 1% of the purchase price, correct?
Exactly. So if you're buying a property for $200,000, you'd want to see it generating around $2,000 a month in rent. It's a quick way to gauge whether the property could be a solid investment.
That makes sense. And I imagine that's especially useful for someone just starting out, right? You don't want to get too bogged down with numbers initially.
Absolutely. And keep in mind, it's not the end-all be-all. It's just a guideline. Sometimes properties in higher demand areas might not meet that rule, but still offer great long-term value.
Good point. What about the 50% rule? I've heard that's another handy tool for investors.
Yes, the 50% rule suggests that roughly half of your rental income will go towards operating expenses. So if you're pulling in $2,000 a month, you'd budget about $1,000 for expenses, things like property management, maintenance, and insurance.
That helps paint a clearer picture of your potential cash flow, huh?
Right. And if you want to get even more detailed, you could create a checklist for evaluating deals.
Ooh, I like that idea. What would be on your checklist?
Well, first, I'd include the purchase price and estimated rental income. Then, factor in your financing costs, property taxes, and estimated repair costs.
Sounds super practical. Like, do you have a specific example you could share?
Sure. Let's say you find a property listed at $250,000. You estimate it could rent for $500 a month.
Okay, so that meets the 1% rule right off the bat.
Right. Now, using the 50% rule, you'd set aside $1, $250 for expenses. If your mortgage payment is, say, $1, $200 a month, you're looking at a positive cash flow of $50 a month, which isn't a huge amount, but it's a start.
Yeah, and that's just looking at the immediate cash flow. What about long-term gains?
Exactly. That's where appreciation comes into play. Over time, property values in that area might increase, and you could also benefit from tax deductions.
Speaking of taxes, how does financing through life insurance impact that?
Great question. When you finance your life insurance premium, you're essentially borrowing against the cash value of your policy. The interest you pay could potentially be tax deductible, depending on how you structure it. So it's crucial to consult with a tax professional.
Right, and it's all about making the numbers work in your favor. So how do you determine the best property types or markets to invest in?
Well, I'd suggest starting with areas that you know well. Look for markets with strong job growth, good schools, and amenities. These factors tend to increase demand.
And, I think it's also important to consider different property types, right? Single-family homes versus multifamily units?
Definitely. Multifamily properties can often provide better cash flow since you have multiple rental incomes coming in, but they also require more management.
Right, and for someone over 40, they might have different priorities. Maybe they prefer a more hands-off approach?
Exactly. So they might lean towards single-family homes or even consider investing in a REIT real estate investment trust if they want to avoid the day-to-day management altogether.
That's a nice option, too. So if someone is thinking of using life insurance premium financing, what are some key steps they should take?
Start by assessing your current life insurance policy. see if it has cash value, and talk to your insurance agent about the financing options available to you.
And then, I guess, gather your real estate data.
Right. Start analyzing potential properties using the 1% and 50% rules. Create that checklist we talked about, and ensure you have your financing lined up.
That sounds like a solid plan. And I suppose it's also wise to consider your exit strategy.
Absolutely. Knowing when and how to sell your property or when to refinance can significantly affect your long-term wealth.
So that leads us to common pitfalls. What are some things to look out for when using life insurance premium financing?
Well, one major pitfall is over-leveraging. If you stretch yourself too thin with debt, it can backfire.
Yeah, I can see how that would be risky.
Another issue is not having enough of a financial cushion for unexpected expenses. You want to maintain some liquidity.
That's crucial, especially in real estate where surprises can pop up at any time.
Exactly. And also, be cautious about relying solely on appreciation for profit. The market can be unpredictable, so you need to focus on cash flow as well.
That's great advice, Mike. It really seems like having a well-rounded approach is key to successful investing.
Totally agree, Sarah. Balancing your strategies and keeping an eye on the market can lead to sustainable wealth building over time. So when we talk about common pitfalls in real estate investing, one big mistake I see is over-leveraging.
Yeah, I can see how that might happen. It's tempting to think, the more I borrow, the more I can invest, right?
Exactly. But it can backfire quickly. I remember a client of mine, let's call him Tom. He took out a really hefty loan to buy multiple properties at once, thinking cash flow would cover it. But when the market shifted, his tenants started moving out, and suddenly he was, stuck with high monthly payments and no rental income.
Ouch! That sounds stressful. So what happened next for Tom?
Well, he had to scramble to keep up with the mortgage payments. He ended up having to sell one of his properties at a loss just to, stay afloat. It's a harsh lesson on how important it is to ensure that your cash flow can handle your debts.
Right. And I guess that ties into the importance of understanding your cash flow, huh?
Absolutely. A lot of investors, especially new ones, overlook cash flow analysis. They see the potential rental income and get excited, but they forget to factor in things like maintenance costs, property management fees, and vacancy rates.
It's those hidden costs that can really sneak up on you, huh?
For sure. I had another client, let's call her Lisa. She bought a rental property thinking it was a great deal, but she didn't account for the age of the roof. A few months in, she faced a major leak, and guess what? A new roof set her back several $1,000s.
Oh no! I can imagine that would make anyone feel disheartened. How can investors spot those red flags early?
Well, doing thorough inspections is key. Always dig into the property's history too. Look for any signs of deferred maintenance. If a property looks great on the surface, but has age-related issues lurking beneath, it can really come back to bite you.
That makes a lot of sense. And speaking of red flags, what about bad tenants? That's something else I hear about quite a bit.
Yeah, bad tenants can really derail your investment strategy. I remember a case where an investor, let's say his name is Mark, he skipped the tenant screening process because he was in a hurry to fill the unit.
Oh no.
Yeah, Mark ended up with tenants who were consistently late on rent, and they didn't take care of the place at all. It turned into a nightmare, with eviction processes dragging on and, legal fees piling up.
That's tough. So what would you recommend instead?
You've got to take your time with the screening process. Check references, run credit checks, and even talk to previous landlords if you can. It's an investment, and you want to protect it.
Absolutely. And what about the idea of timing the market? I feel like that's a common trap too.
Oh, definitely. Many investors try to time their purchases based on market trends, hoping to buy low and sell high. But that can be risky.
Right, because the market can be unpredictable.
Exactly. I had a client, let's call him Dave, who was waiting for what he thought would be the perfect time to buy. He kept saying, "I'll wait until prices drop." But while he was waiting, prices actually kept climbing, and he ended up missing out on some great opportunities.
So instead of trying to time the market, what's the better approach?
Focus on the long-term value of the property rather than the market fluctuations. If the cash flow makes sense and you can hold onto the property through ups and downs, that's usually a safer bet.
That's a solid strategy. And what about when it comes to financing? Are there pitfalls there too?
Oh, for sure. Many investors get caught up in the excitement of financing options without fully understanding the terms. I had a client, let's call her Emma, who jumped into a financing deal that looked great on paper, but had hidden fees and high interest rates.
That sounds like a recipe for disaster.
It was. She ended up paying a lot more than she initially thought, which affected her cash flow. So always read the fine print and, ask questions. Don't be afraid to shop around for better financing options.
Such important advice. And what about those who might already be in a tough spot, facing some of these challenges?
If you find yourself in a bind, it's essential to reassess your situation. Look at your expenses, see where you can cut costs, and don't hesitate to seek advice from a financial advisor or a real estate mentor.
Yeah, I imagine having someone experienced to guide you can make a huge difference.
Absolutely. And remember, it's all about learning from these experiences. Every mistake is a lesson in disguise, right?
Definitely. So, for someone looking to move forward, what's a good next step?
Start with education. Read up on real estate investing. Connect with local investor groups and maybe even find a mentor. Build a solid plan before diving in again. And take your time. Real estate is a marathon, not a sprint.
That's a great perspective, Mike. Taking it step by step can really help build that foundation for long-term success.
Exactly. And, don't be afraid to ask for help when you need it. It's all part of the journey.
Well, that's some solid advice. Thank you for sharing, Mike.
Anytime, Sarah. It's always good to chat about these important topics. All right, so now that we've laid the groundwork for life insurance premium financing and how it can be a game changer for property investing, let's dive into some immediate steps folks can take to really put this knowledge into action.
Absolutely. It's one thing to talk about it, but I think people want to know, what can they do today?
Exactly. So first off, a great initial step is to get familiar with the market. If you haven't already, you might want to check out apps like Zillow or Realtor.com. They're super user-friendly and can give you a feel for property values in your area.
Right, and it's a good way to see what's actually out there. You can compare prices, look at different neighborhoods.
Exactly. And once you're comfortable with that, I recommend using a calculator like BiggerPockets or DealCheck. These tools can help you analyze potential deals more effectively.
Oh, those are so helpful. They break down cash flow, expenses, and even ROI.
Yes, and if you're looking at rental properties, Rentometer is a great tool to see if your rent estimates are on point. It can provide insights into local rental rates, which is crucial if you're planning to finance a property through life insurance.
Such a smart way to ensure you're making informed decisions, especially when you're starting out.
Right? And another thing to consider is accessing your local MLS. It can provide even more in-depth data about properties, including historical price trends.
That's super valuable, and if you're not super tech-savvy, just reach out to a local realtor. They can guide you through the process and provide insights that might not be available online.
Absolutely. And speaking of local resources, joining a local real estate meetup can be a fantastic step. You'll meet like-minded individuals who might share their experiences and strategies.
Networking is so important in this business. Plus, you can learn from others' successes and mistakes, right?
Yes, and it can really boost your confidence. Speaking of confidence, I think it's important to start small, maybe commit to analyzing one deal a week.
That's a manageable goal, and it helps you build that analytical muscle over time.
Exactly. And as you get more comfortable, you can gradually increase your analysis to 2 or 3 deals a week.
And don't forget to keep learning. There are some fantastic books out there, like the book on rental property investing by Brandon Turner.
Great recommendation. And there's also Rich Dad, Poor Dad by Robert Kiyosaki. It's a classic that really shifts your mindset about money and investing.
And podcasts. There are so many out there. BiggerPockets has a wealth of episodes focused on real estate investing.
That's a solid choice. You get to hear from real investors sharing their experiences, which can be super inspiring.
Yeah! And if you want something a bit more niche, look for podcasts that focus specifically on financing strategies.
Definitely. And remember, it's all about starting where you are. You don't have to know everything right away. Just take one step at a time.
Absolutely. Celebrate the small wins, right?
Yes! and make it a habit to review your progress. Maybe set aside time each week to evaluate what you've learned or what deals you've analyzed.
That's a great idea. And keeping a journal or a spreadsheet could be really helpful to track your thoughts and insights.
For sure. And don't hesitate to reach out to professionals like financial advisors or insurance agents who understand life insurance premium financing. They can provide tailored advice based on your situation.
That's crucial. You want to make sure you're making informed decisions, especially when it comes to financing and investments.
Exactly. And look, it might feel overwhelming at first, but remember, everyone starts somewhere. The important thing is to take that first step.
And keep moving forward. So those are some practical first steps. Now let's bring this all together.
So, as we wrap up, let's quickly summarize some key takeaways from our chat about life insurance premium financing.
Yeah, absolutely. First off, using life insurance as a financing tool can really help you leverage your investments.
Right, and it provides a unique way to access cash without the traditional hurdles of loans. It's all about making your money work for you.
Exactly. And remember, it's also about protecting your loved ones while you're building that wealth. It's a win-win situation.
For sure, and another point is that this strategy can help you diversify your portfolio. You're not just relying on one type of investment.
Yeah, diversification is key. And the potential tax benefits. I mean, that's something worth considering, right?
Definitely. It's a complex topic, but with the right guidance, it can be a game changer for your investment strategy.
So as we've discussed, real estate investing can be a powerful way to build long-term wealth. It just takes some patience and the right approach.
Absolutely. And remember, it's never too late to start investing. If you're in your 40s or beyond, there's still plenty of time to create that financial legacy.
Speaking of which, we'd love to hear from you. If you enjoyed today's episode, please like, subscribe, and let us know your biggest takeaway or any questions you might have.
And if you know someone over 40 who's interested in property investment, share this episode with them. You never know who might benefit from this info.
Next time, we'll dive into virtual wholesaling, which is all about finding deals remotely. It's going to be a fascinating discussion.
It sure will. So don't miss it.
Thanks for tuning in, everyone.
Take care and happy investing.
Bye for now.